There's no reason to become alarmed, and we hope you enjoy the rest of your flight. By the way, is there anyone on board who knows how to fly a plane?
Welcome to Avoiding Real Estate Turbulence podcast. This is your pilot, John Lafferty, with Century 21 Town & Country.
And co-pilot, Tony Bucci, with Ross Mortgage. And we are your real estate pilots. Our job is to be your real estate advocate and also make sure you're educated about the buying and selling process. We'll keep you informed throughout until we get you safely closed.
In a real estate transaction, there are many reasons why you can encounter turbulence. Today, we are going to talk to local expert Tony Bucci on ways to avoid turbulence hitting your savings and investments and retirement. Tony's with Mission Point Planning and Retirement. Welcome to the jump seat, Tony.
Thanks, guys.
I should say welcome back to the jump seat, Tony.
I didn't do. I guess I flew well enough last time to earn a ride again. I appreciate
a return
guys.
flight. Yeah,
no doubt.
Sometimes we throw people off the plane.
That's
so
okay. That's all right.
Yeah.
For those who may have missed the last podcast, Tony, tell us a little bit about Mission Point Planning and Retirement.
Yeah, thanks so much. First off, thanks for having me back again. Mission Point Planning and Retirement, we're an independent financial advisory firm in Troy, Michigan. I've been doing it about 16 years, soon to be my 16th. We specialize in helping folks in two real big areas. One, financial planning, true financial planning, which is helping people make decisions based on their unique circumstances, goals, wishes, et cetera, and then actually implementing those decisions through proper investment strategies, and with a special focus on retirement.
Okay. Out of curiosity, when is a good time for somebody to sit down with their financial planner if, let's say, they're maxing out their investments every year, they own a house, but they want more investments or strategies? When is a good time for them to sit down and talk with their financial planner about maybe an investment property? Yeah,
I mean, if they're already having a relationship they already have a good relationship with a financial advisor, these things typically come up it should come up during an annual review or biannual review. And usually it's posed in the question of, hey, I'm doing all this. Should I be doing anything more other than just saving more? And this is where we have to walk a fine line, because legally we're not allowed to suggest a specific investment property or business, because it's out of our purview. We're not licensed to do that. But the reality is that we know that mutual funds, stocks, bonds, annuities, insurance, these are not the only things out there. There is a lot to be gained from a passive income that can be generated through an investment property. Or in some cases, if somebody is maybe a little bit more handy, someone who can take on a flip. The thing that we talk to folks about, though, specifically in regards to these investments, and I'll throw in businesses too, passive, ownership in business or whatnot, that these fundamentally are different animals than what we're doing, in that they require a lot more. There's a little bit more, actually quite a bit more, could be quite a bit more risk, and certainly more of an expectation of time, energy, and then therefore return. So to the point where if somebody wants to flip a house, for example, we say, hey, that's really income. That's not really an investment. You're making money. That's an income situation. And then, of course, the real estate, some passive income through rental property, or vacation property through Airbnb or VRBO or something. Or
we're going to get into that.
Absolutely. Certainly, the sooner the better. And then whether it's right for them, I think the number one determining factor is their temperament. Can they administer that particular property? A lot of people want to. You guys will probably take over from here on this one, but a lot of people want to be investment property owners, but there's a lot more to it than just looking at a piece of paper and saying, this is what I could have.
What? Really? You just don't throw money at a property and it just makes money for you, hand over fist, to grow it on trees?
I think one of the other reasons to call you into the conversation sooner than later is that it takes upfront capital, right, to make the investment or vacation home happen. And reasonable likelihood they're going to be reaching into upfront capital that you've helped them get to that point. Yeah. And what I like to tell folks that are at that stage is, you don't want to upset the apple cart. If there's a plan in place, I mean, we can talk all day long from my perspective about how the finance works and the costs and the payment, et cetera. But if doing so is going to upset some other part of the financial plan, that's a dangerous place to be. They should bring you into that conversation sooner than later, I think.
No, absolutely. And I think, and this kind of goes back to some of the things we said in the previous episode. If you're working with a quote unquote, air quotes are happening right now, a financial planner who is really an investment manager, they're not really going to want to, they're not going to want to take any capital out of what they're managing for you to reallocate towards somewhere else. If you're working with a fiduciary on the financial planning side, just someone who really is just focused on trying to create a plan and help you make decisions at what's best for you, they're more apt to say, okay, yeah, we can take some capital out of what we've been doing already because the positive attributes of owning a secondary real estate property, I believe outweigh. Of course, once again, we're not allowed to recommend specific things. That's where you guys come in. That's where John comes in. But that's the thing you have to, if you're listening to this right now and you're working with an advisor or thinking about it, you need to be aware of, because there's a vested interest for financial advisors to keep most of your money with them.
Yeah. Well, with that all important rule of diversification, though, it's worthwhile to say, hey, in the interest of diversification, this is one of the things that I want to talk to my financial planner about. Yeah. Right? I mean, is that
absolutely? And that's you hit the nail on the head, actually. So we preach diversification, and sometimes we need to think about diversifying beyond just the traditional things that we can do. And there's this really comes into focus, I think, for our clients that are either approaching retirement or in retirement, and where the success or failure of retirement. We'll go back a few years even. We'll say maybe 10 years out from retirement. It hinges on income or cash flow. The financial press have done a great job of portraying retirement as a number decision. Like once I get to a number.
Well, 65.
Yeah, exactly. Or 60 age or like a certain dollar amount. Yeah, exactly. Yeah. In reality, it's not the dollar amount's nothing. That's important, but it's what is my dollar amount generating from an income perspective. Yeah. And so if a certain amount of money can generate a higher degree of income and the owner, the client has a temperament to own real estate, that's a perfectly acceptable, in some cases should be encouraged because it's a bigger bang for their buck to generate an income. And it diversifies. I mean, we know most of the time stocks, bonds, and real estate don't work in lockstep with one another. Unfortunately, one time it did, 2008. But a lot of times stocks could be down and your real estate holdings could be doing okay. Yeah. So you're absolutely right, Tony. Diversification is a key element in deciding whether this is good for you.
Yeah.
Tony, when somebody's looking at an investment property, what's the minimum they can put down? Is it 15%?
Yeah, for conventional loans, it is 15%. And like so many aspects of financing a property, the larger the down payment, the more attractive the terms become. And I think that's a little bit exaggerated on the investment property purchase. So when somebody puts 15% down, they can do it, but they're going to, you're in that window where you're going to pay PMI. And you're in a situation where you're going to pay a higher interest rate because you're putting what's considered to be the minimum down for a conventional loan purchase on investment property. Things become more attractive at 20 and 20% down. The analysis is different. It's cash flow and it's what's going to happen in the future. So if it's a killer buy with some great upside potential, maybe that additional expense of putting 15% down can be justified. But we really try to discourage people to jump into an investment property purchase with 15% down because that's all they have to invest. That's kind of a dangerous place to be.
Okay. Let's take a step back and say that from the get-go, maybe the property is either even or they're probably not making enough to cover PMI. I'm sorry, PITI.
Sure, the payment.
Let's say that in the beginning, for a year or two, that's just the way it's going to be. And let's just say that where they're looking to buy is an area that's growing and developing, and it's not anywhere near its full potential. Is that taken into consideration where you can eventually see rents getting to a point and surpassing so that they'll be making money at some point? Do you take that into consideration, or is it just this is a loser, rents don't support this sort of mortgage value, we need you to put down more money? Is it black and white? I know it's a lot to throw at you.
No, boy, is that an excellent point, though. If I think back to something we preached about in the previous episode, it's these decisions aren't made in a vacuum, right? And so to use the fancy lingo, if somebody is underwater on the cash flow, they're paying more than what they're getting in, but there is upside potential that they're banking on. The first thing is, what else is going on in their financial world? If they've got robust income and they can cover that shortfall, then great. But if the only way they can afford that property is by the offsetting incoming rent, that's a really precarious position. And much like Tony can't suggest a particular property or real estate investment for as part of the overall financial planning, we really can't get into a speculative conversation about well, it may not look so rosy now, but boy, read the paper. Here's what's happening in that community in 5 or 10 years. That's a really risky place to be. I really try to advise people in this kind of situation is, can you afford it in the worst case scenario? If you have 6 months without a tenant, and goodness knows that happens, if you incur unexpected repairs, and tenants aren't terribly tolerant with something like that. If the roof starts leaking at 2:00 in the morning, you're going to get that phone call at 2:05, and you gotta spring into action. So, does it come into consideration? Yeah, from the finance standpoint, though, we don't want to get speculative as to coming to the conclusion that you should buy this and you should finance it because of something that's going to happen down the road. And Tony, is that not a fair conclusion on pretty much any investment, really? Yeah.
No, absolutely. And that goes to the fact that the point that real estate is, from my standpoint, is a different kind of investment. It's definitely an active participant investment.
Yeah.
You bring up a great point about people that on paper I said earlier, people on paper want to own real estate, but the reality is, yeah, if the tenant calls and 6:00 in the morning and something needs to be fixed, you not only need the time to do it, but you need the capital.
Yeah.
It's a lot like owning a business. You can't run a business just simply based off of cash flow. You have to have reserves to make, and actually that's how your own financial life should be too. You can't, if you're running your real estate venture plus your personal life on a paycheck by paycheck basis, if one thing goes wrong, then yeah, you have to make less than optimal decisions.
Yeah.
That's financial code, planner code word for borrow to get out.
Emergency.
Yeah. So no, you're absolutely right. Absolutely right. Yeah. I mean, do you find that people tend to get really excited by investment properties more because of the potential gain they see in the short run? Or is it something that's more of the long run they go into?
I think it's more of the long run.
Yeah.
I've certainly had investors buying in an area because they see the potential for it and see where things are starting to happen. And, let's be honest, a lot of these areas that are up and comers, it doesn't happen overnight. It's a process. Royal Oak is Royal Oak. And then you have surrounding communities that were really not much happening in the 2008, 9, 10, 11. Shoot, in 2012 and 13, I remember selling homes in certain communities for an unbelievably cheap amount. And now those same houses are selling for triple or quadruple what they were. And rent, same thing. Rent is now almost double or in some cases triple what they were collecting at that time. So I see it, and I see the potential for people wanting to invest in up and coming areas. Does the rent justify what they're getting it for? Not always, but and that's why I say, sometimes you take a little bit of a haircut in the beginning, though it's not ideal. And then eventually over time, and I'm not talking about losing money, being upside down. I'm talking about just the cap rate in general. How much money you're making on your investment, and ideally you'd want that to be somewhere between 4 and 10%. But if it's an up and coming area and your cap rate is on the low end, a 3 or a 2, but there's potential, I still might advise an investor to buy that property for long-term gain.
Yeah, I don't disagree. I'll use a term from Tony Bucci's industry, and that is risk tolerance.
Yeah.
What are you comfortable with? I mean, if that strong potential upside is at some point in time and down the road and you don't know when, and you're questioning your own finances, that can lead to some sleepless nights. That's for sure. The thing that I sometimes worry about, though, is I think there's some inherent sexiness to being a real estate investor, and I think everybody knows. Well, I'm not quite sure how it's happening, but I know this person that owns all kind of rental properties, and they make a pile of money. And there could be truth to that conclusion, but what's usually not known is what's the rest of the backstory. What else is going on that makes it all happen? When you get really granular as far as what's happening on a property by property basis, they're probably seeing the kind of returns like you're talking about. Maybe it's 4 or 5% with that rental income, which is fine, but no one's going to get rich overnight with that kind of thing. So I always worry when someone's looking at and Tony, I think that's with any investment. Absolutely. I'm not quite sure how it's going to work, but I know if I go down this path, I'm on the roads to riches, and that path doesn't exist. There's not a guarantee, is there? Yeah.
But it's funny that you brought about risk tolerance, because one thing that we notice in our world, and I would guess this happens in real estate, is that success breeds aggressiveness and also breeds complacency. So if you've had a couple, say you've flipped a few homes and you're making a lot of money off of those 2 flips, you tend to have your risk tolerance tends to go up because you are comfortable with it, but you maybe should be slightly less comfortable with it because every situation is unique. So we see this in the stock market and the investing world. As the market goes up, everybody becomes more aggressive.
Good point.
As the market goes down, everybody becomes more conservative. When in reality, it should be quite the opposite. In hindsight, it's always easy to say that 2008 and 2009 was the best time to buy flips. But
2012.
Yeah, exactly. But sometimes there can be bred in overconfidence. And I did hear this from, I think it was actually on the Dave Ramsey show, who he mentioned he used to invest in real estate. And he talked about how sometimes people who do a lot of real estate investing become immune to risk because they were so successful at it. And sometimes it only takes one negative experience. But same thing in stocks too. So, but yeah, the concept of risk tolerance and always grounding yourself of like, what's the reality? What are the, as you guys were talking about, what are the numbers? What's, because at the end of the day, an investment, whether it's a stock or real estate, it's all that matters is what you bought it for relative to its potential value.
That's a good point.
So if you bought in Clawson or you bought in Royal Oak, Clawson's actually, that's a bad example. Say Hazel Park or Royal Oak, right? Hazel Park is not as sexy as Royal Oak, but maybe it's tremendous. Maybe there's a much more value.
Sure.
As someone who's looking at Royal Oak right now.
That's exactly right. And
this is what happens when you let a financial advisor speak on real estate. It's all what I think, right?
You brought up a good point. And speaking about people who flip homes, flip home, make money, flip home, make money, get a little cocky after 8 or 10, and all it takes is that one that has a little more risk than maybe the others to get burned and lose your shirt. Yeah. It only takes that one, and seen it happen before, where they have to shut down. They lose everything on one of those houses and take a big haircut.
It looks so darn good from the outside. When you're looking at it from the surface of, hey, I can buy it for $35,000 or $40,000, and everything else around here is selling for $120,000. Well, who wouldn't be intrigued by that type of thing? It's all the stuff that happens in the middle that's problematic. And that's where it gets. And you're right. Flippers will say it took longer than I thought it would, and I spent more than I thought I would. I still made some money, but those were 2 things, and I think this is a key thing. Those were 2 things that I did not plan on happening that happened. Mm-hmm. Yeah.
That's exactly right. You spoke earlier about temperament and whether or not somebody has the type of temperament to be an investor and own rental properties, and it just made me think that it's true that the people that know themselves well enough that they don't want to be called at 3:00 in the morning that the toilet's plugged and it's flooding, or there's a leak in the basement, come fix it right away, or the furnace is out and it's dead nuts in the middle of winter. What do I do? The people that don't want those calls hire a go-between, a property management company, and so if that's factored in the costs. And I don't know, Tony, and when you sit down and you figure out your standard, okay, this is what the home is going to produce, this is what their PITI is there a number that you factor in to cover other things, or is it just PITI and this is what their payment's going to be? This is what a house will rent for. We're good.
Yeah, it's a little bit of a progression. What we like to do from the mortgage perspective is that we like to make sure that the person can qualify for that mortgage as if there's no rental income. And John, I know on the real estate side, that's like, well, what the heck are you talking about? Of course there's going to be rental income. But just in being conservative and prudent, it's like if we can make it work and there is no rental income, then from a mortgage risk standpoint, we've got a wonderful scenario. But there are mechanisms where we can use projected rent. We can do two things. We can use projected rents as put forth by the appraiser who's done objective analysis on that. Or we can use an existing lease if somebody, for instance, is refinancing a property and say, look, this is what I have in place, or I'm purchasing it and a tenant has signed in conjunction with me to rent. We can take that into consideration. We'll give it a haircut. We'll generally only use a percentage of that incoming rent for obvious reasons. There's expenses that go along over and above just that monthly payment on the financing.
I'm curious, what are guideline rules regarding somebody turning a home that they're moving from into a rental? Can they show what rent would be and use that as income towards the purchase of their new home? There was a time not too long ago where you had to have a renter in a place for 2 years, if I'm correct, that I recall during the bad time. Is that still the case? In order to count that as income towards your new purchase?
A great question, John. It's been dynamic. Prior to the recession, if somebody wanted to buy a home and not sell their existing home and they wanted to offset that existing debt, miraculously a lease would just become available and say, oh, well then, this will cover my mortgage payment. And then there it went. And then now comes the recession, and then that became verboten for obvious reasons. And I'll always say, bad guys reckon for the good guys. And so that was put on hold. No, if you are converting a primary residence to an investment property, that is, sorry, you got to be able to carry that debt service. Now, as things are becoming a little more healthy, and I know that's a arguable term or relative term, if somebody is converting a primary residence to a rental property because they want to buy a new primary residence and they do have a lease, we can use that lease to offset the existing debt on that current residence. We're careful about it. I mean, we want to see the fully executed lease. We want to see that deposit that renter has given what is now the landlord to at least give some degree of validity to it, because it was abused pre-recession for sure.
Is somebody doing a drive-by appraisal of the house to see if somebody's living in there or the condition of the home, along with that other information?
So you're talking about the property that they've turned into a rental?
Correct.
No, but I will tell you this. So, of course, what are we approving? We're approving the mortgage on their subsequent purchase. If that loan starts to go into default, now we're going to start peeling back the onion, and we're going to see, well, is everything that was told at that point in time true? It's a little after the fact, but that's kind of how that process goes. And because here's what the lender is going to try to do, whether or not, if there was some indication of fraud at the application, hey, I said there was going to be a tenant and now there never was a tenant, well, then that home buyer has the risk of having their note called accelerated and due in full because they misrepresented what was going on in the loan application.
Interesting.
Yeah.
One of the other things I wanted to get to, we're running a little short on time, but I wanted to just talk briefly about second homes, people who buy cottages up north, homes that are on lakes up north, or elsewhere, or income properties, homes that are on lakes with the idea that, hey, I'll just rent that out. And one of the things that I found really interesting is, as of right now, if a homeowners association or an association in a subdivision or a beach association where homes reside, if there are a set of CC&Rs, conditions, covenants, and restrictions that strictly forbid it, you've got a problem.
Yeah.
You can't do it. And so I bring this up because I've talked with people who have wanted to buy properties in areas where tourists and travelers go and say, hey, I could buy this property here. I can go up and enjoy it. I can't get to it every weekend, but I can Vrbo or Airbnb it when I'm not there, make some money, help me offset the mortgage costs. I can do all of that. Well, guess what? If you don't do your investigations to find out if there are bylaws or CC&Rs that prohibit that, and you buy that house with that idea and then find out after the fact,
Yeah.
you will get shut down in a hurry. And so, it's a to borrow a term from you, it's an onion right now that basically these communities. And, I can see the argument from the people that live there that I don't want a bunch of yahoos, 20-something-year-olds, 30-something, not to say that it doesn't happen with older people too, but I don't want these yahoos coming in and making all this noise, tearing up the whole area, leaving trash everywhere, and then they go away back to where they came from, and then I'm the guy that's got to go out and pick it up, and I got to deal with this every weekend, and this is what I want to get away from, which is why I come out here, or why I bought this home in the first place. So I understand it from that perspective, but I also understand it from the other perspective, which is, hey, I bought this house, I own it, why who are you to tell me what I can do with my property and who I can let live there or let rent there? So I see it from both sides, and I understand it. Currently there's a law, not a law, but there's a bill running through the House that they're trying to pass, which would essentially allow homeowners by state law to rent out on short-term leases these properties to tourists or travelers, and make these rules inside associations toothless.
Yeah.
It's interesting that you bring that up because, and it's going to be interesting to see how other states handle this too. Because I know Florida, for example, I mean, given the fact that it's a big snowbird state, that those rules absolutely exist. We were talking earlier. I just came back from a vacation at my in-laws' place in Marco Island, and their condo has rules that say you can only rent to one person per month, no short-term rentals. That person might only be there for a couple of days, but that's it for your month. And it's interesting how different. It's going to be interesting to see how the law develops and how different communities handle that, because it's certainly in my world, we know the statistics. 10,000 baby boomers are turning 65 every day. And there's a strong, and as technology has enabled us through VRBO or Airbnb to rent homes in these places, there, as you guys talked about, there's a desire just to buy these places just for the investment potential of them. Yeah. So that's I never even thought about that until you brought it up, or I just kind of just lived through it. Because that would severely affect the quality or the price you would want to pay for that particular investment.
Absolutely. Could you imagine spending $500,000 to live on one of the lakes up north, and it's a peaceful, serene community, and all of a sudden, every weekend, the house next door to you, here come these people partying and running around and swimming and making noise all night, and all you want is peace. It would absolutely affect the value. And same thing with condo associations up there as well. It would make a big change. But
so am I the guy partying, or am I the guy?
You're the guy partying. Yeah, you're the guy drinking too-hearted all over the place.
Not with little kids anymore.
Yeah.
There's so much more I wanted to get to that I know we wanted to get to, but gosh, we're short on time. And
we could do a whole nother episode on that.
We could. We'd love to have you back again if you don't mind.
Thank you.
Coming soon, I guess. We'll figure out another date that works for your schedule to have you back. But hey, we'd like to thank you again, Tony, for coming by. Tony Bucci with Mission Point Planning and Retirement. Tony, how do people get in touch with you if they want to sit down and talk about their finances or planning or, heck, anything to do with their money?
Absolutely. Thanks so much again. Thanks, Tony and John. We're local. You can reach us at 248-504-6015. Great resource to check us out is our website at www.missionpointplan.com, 3 words altogether. We put a lot of our original thoughts, our ideas, our opinions on our blog. So if you're investigating us, you can get a really good feel of what we stand for and what we believe by going there first. And then and all initial consultations are all complimentary. So there's we definitely are a no pressure type of firm as well. So, but thanks again, guys, for having me.
Yeah, you're welcome. Tony, this was great. Thanks for coming on. That's for sure. This was a fun episode. Hey, thanks for listening to Avoiding Real Estate Turbulence. If you'd be so kind to subscribe, review, and rate us, we would appreciate it. Please share it with your friends, family, and coworkers that they can find us on Apple Podcast, Google Podcast, and Spotify.